Hello, everyone. Welcome to the Weekly Watch. I'm Brian Daingerfield, the co-head of G10 FX Strategy and NatWest Markets, filling in for John Briggs. After weeks of uncertainty, tension in Ukraine has really boiled over. As we record on Thursday morning, after a series of relatively smaller provocations, Russia has launched a full-fledged invasion into Ukraine, and risk assets have reacted swiftly. Equity markets are plunging to new lows, for 2022. And energy prices have moved higher, with oil prices in Europe, the Brent front future, rising above the symbolic $100 per barrel level. Happy to be joined today by our head of EM strategy, Alvaro Vivanco. Alvaro, could you give us a rundown of the current situation in Ukraine and what we're thinking about the possible evolution of the situation and what it might mean for risk assets from here?
Thank you, Brian. As you said, this is something that the market had been following for the past few weeks, but clearly a full invasion like the one that seems to be taking place in Ukraine wasn't priced in. Our bias had been that there was always a disconnect between what the geopolitical experts were telling us and what the market was expecting, or to some extent hoping for. And today, those two realizations come to conflict, and the reaction in the market is not surprising, right? We've seen, as you said, oil prices hitting new highs, selling off of risky assets across the board. In some cases, the positioning had been a little bit lighter, right, than in the past. We already had seen a correction, also given the fact that developed market central banks have been moving up the hawkish rhetoric over the past few weeks. But nonetheless, the developments overnight are particularly worrisome. It seems to be that, Putin has decided to carry out an invasion throughout the country. The headlines are moving very, very fast. But compared to the scenarios that we laid out in our piece last month, this is clearly the most aggressive option of all the alternatives that Russia had. What we are still expecting is the full reaction by the US and by the West. We should probably hear from President Biden over the next few hours. Again, there are still some alternatives on the table, from probably increasing the number and the importance of the banks, the Russian banks that will be sanctioned. That seems to be pretty straightforward. They had already taken action against a couple of relatively small state-owned banks earlier this week. There's also the possibility that they will exclude or limit exports of software and high-tech materials to Russia. Again, I think that that's relatively straightforward and direct. The big question still is whether they will the US and the West will implement a full restriction of Russia of the financial system through the SWIFT interchange messaging that basically will blockade all banks and all transactions. It seems pretty extreme. Biden himself has said that this will be the last option. Given the actions taken by Russia, it seems proportional, right? It seems like it corresponds to the most aggressive course of action by Russia. Whether it is actually implemented remains to be seen. There's clearly negative consequences for the whole financial system if that's taken. My sense at this point is that probably it will not be the next step that they will try to continue to implement. But as I said, the developments are moving very, very quickly.
One thing you mentioned that really stuck out to me is you mentioned that this is all happening against a backdrop of hawkish central banks and very high inflation. Now, you've had energy prices have moved higher as a result of these developments, along with a sell-off in risky assets. And I think that creates a really difficult position for a lot of central banks in developed markets. Clearly for the European Central Bank, who had just recently made a hawkish pivot of their own, this is going to be a very challenging environment where you have natural gas prices in Europe have moved up over the past 24 hours fairly significantly, and inflation is already uncomfortably high. But this has the possibility of further damaging disposable income, because you simply have this higher fuel costs that can sap discretionary spending, for example. Here in the US, I think the real focus will be, what does this mean for the Federal Reserve, who, as we know, is expected to begin increasing interest rates at their meeting coming up in mid-March. Now, there's been the debate about whether or not the Federal Reserve would consider going 25 basis points, which was the standard increment for increases during the last cycle, or whether they'd be willing to take a more aggressive move at the beginning. It seems like the most recent commentary we've been getting from the Fed has suggested that they would take the 25 basis points option. But this is certainly going to add complication to that picture. I mean, for the Federal Reserve, we have inflation that's already too high. And these oil price moves and natural gas price moves is something that could add to that hawkish anxiety from the Federal Reserve, even if the growth impact in the US is relatively limited. I think it's very fair to say that the direct exposure for the US to Russia and Ukraine is small, especially relative to most of continental Europe. And so as we look ahead to next week and we think about where the hawkish central banks, how they need to react to the developments in Ukraine, we'll look ahead to Chair Powell's testimony on March 2nd. That's going to be a key moment where he could signal 25 or 50 basis points. But one thing I think we should internalize is that the moves higher in energy prices are making an uncomfortable inflation situation even more uncomfortable, but the direct growth impact to the US is probably going to be more limited. And so there's probably a limit to how much the Fed is willing to provide a dovish pivot in this environment to maybe support riskier assets. So Alvaro, I want to continue and ask you a little bit about emerging market currencies. Before Thursday's major escalation, emerging market currencies, I think, had performed fairly admirably, with ruble as a notable and understandable exception. We were not in an environment where we had this "it's all one trade" mentality, where all emerging markets were falling or rising based on tensions. You had some outperformers and some relative laggards. Can you talk a little bit about the conditions that sort of created that environment, and which currencies you think can continue to maybe outperform relatively, even though you've had this pickup in escalation, which has hit risky assets sort of as a whole?
Yeah, absolutely. Today is pretty much the first day that you see wider reaction across EM, which makes sense, right? Given the gravity of the developments and the fact that risky assets across the board are selling off. EM FX obviously is not going to be immune to that. But as you said, up until today, it had been a very, very resilient response by the market. And I think, we wrote about this a couple of weeks ago. I think the market mentality was, there are not many options out there to express risk. Some developing markets already have carried significant rate hikes. So we're towards the end of that. And valuations, in terms at least of PE ratios for some equity markets and some bond markets, are fairly attractive. We're at historically high level. So that's what we had seen, a lot of excitement, and things like Brazilian real, for instance, and Brazilian equities being extremely resilient to the developments. I think that there will still be an opportunity to fade the weakness that we're seeing, but it's very, very early in that process. I think that we're talking about a couple of weeks for all of this, right? For what's happening on the ground to develop, to see the reaction by the US and the West, and implications for emerging markets. Let me also add that, for emerging market central banks, it's also going to be very, very difficult to react. Some of them are energy importers. All of them are facing very high inflation pressures. They're in the middle of hiking cycles. I think the immediate reaction will be higher rates, right? Or at least the market pricing in more hikes down the road, which is not a bad thing for currencies, right? I think that that's one of the reasons why EM had performed so well. So we had been, bullish in certain cases. I think we retained that bias, but obviously, over the short term, we will continue to see more selling off.
Great, thank you, Alvaro. Thank you very much for listening, and good luck in the week ahead.